Well, before that, let's turn to another very big story, because an emergency move from the Bank of England has made, they did a dramatic intervention today to try to calm the markets following the turmoil after last week's mini budget by the new government. It's launching a temporary UK government bond buying programme to try to get long-term borrowing costs down. Well, it came after a rare rebuke from the International Monetary Fund, one of the world's most important financial institutions, which warned that the government's plans for tax cuts are risky and they could accelerate inflation and increase inequality. Here's our economics correspondent, Andrew Verity.
Ever since last Friday, the Bank of England's Governor Andrew Bailey has been trying to resist taking emergency measures following Kwasi Kwarteng's huge tax cuts to be funded by borrowing. But now, the cost of borrowing on financial markets has forced him to. In an emergency statement, the Bank of England said, were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability. It said it was seeking to restore market functioning and reduce any risks from contagion to credit conditions for UK households and businesses, and it would intervene on whatever scale is necessary to do so. Worried about the credibility of the Chancellor's plans, traders have been selling government bonds, the instruments it uses to borrow money, forcing the government to pay much more in interest to borrow funds over the long term. Now, the bank's trying to counter that by buying the same bonds. Since its announcement, that long-term borrowing cost has dropped, but only by a little, before bouncing again. It's an embarrassment for the Bank of England, which only last week announced it was selling government bonds, not buying them.
I'd have to say that this reaction to keep buying bonds and reverse plans to sell them is a real damaging impact on their credibility. It suggests that the actions of the government last week have put them in a really difficult spot in trying to deal with their primary target, which is to get inflation back to 2%.
But it's not just the markets that don't like the government's plans. The world's lender of last resort, the International Monetary Fund, whose role is to help countries out in financial emergencies, fears the government's plans will backfire. In a statement, it said developments in the UK would be closely monitored and untargeted fiscal packages were not recommended at a time of high inflation. It warned the government that its mini-budget risks increasing inequality.
This is about a confidence game. The animal spirits of the markets you don't want to unleash against you. You want to show that you're a well-organised government with a stable, very well thought-through plan, and that the whole government and the Bank of England are all working as one. So now there's a lot of ground to recover, because somehow you have to show that there is real coherence across these policies.
The kind of warning that Britain received from the IMF today is a kind of warning that comes much more frequently to emerging markets with new governments than to a country like Britain.
The government's hoping that by handing out tax cuts, people will have more money to spend, and that will stimulate the economy to grow and improve living standards. But the IMF is warning it could have the opposite effect. Because the pound's weak, import prices are higher, and that pushes up inflation. And to fight inflation, interest rates have to rise faster than previously thought. And that could hit ordinary people where it hurts, in the mortgage payments. So far, the Bank of England's announcement hasn't worked to calm financial markets. The all-share index of UK-listed companies is tumbling down 2%, and traders are again selling the pound, now worth less than $1.06.
Well, Andy is in the studio here with me. Andy, I mean, another extraordinary day.
It really is. I mean, this reminds me in my 25-year career of what happened in 2008. It also reminds me of what happened in 1992. This is a crisis, I think it's correct to call it, and unusually it's been caused by a budget that wasn't called a budget, and not so mini budget that was in fact enacting the biggest tax cuts in 50 years. The problem being that they were funded by borrowing, and now it's precisely the cost of borrowing that is alarming people. We have pension funds who are forced sellers of government bonds, and that magnifies the crisis and threatened to make it worse, which is why the Bank of England has had to intervene.
We're talking about bond markets, we're talking about gilts. I mean, these are things that are pretty complicated for people to understand, but just take me through the real impacts on people, on businesses, on pensions.
Well, on people, the most important impact is the one I mentioned there in my report on what's going to happen to your mortgage. Even if you're not one of the unlucky 2 million who has a variable rate mortgage in the UK, who will have seen those effects already, you may be on a fixed rate deal. And if that's due to expire in the next year or two, you can expect your monthly mortgage payments to go up very substantially as a result of the changed outlook for interest rates, which has resulted from what's just happened. But another real world impact is pension funds. So just explain bonds. When the government wants to borrow money, it issues a bond. It's like an IOU note. You might hand me £100 as the government, and I promise to pay you £10 a year in interest. But what's been happening here is that they've been selling those bonds because there's less confidence in the government's solvency and its ability to maintain those debts. And that has meant that interest rates are being forced up, and that triggers further sales. So pension funds have mandates that say if the price of those bonds goes down below a certain level, you have to sell more. And that's why I say 1929, because that reminds me of the stop-loss contracts in 1929, which amplified what happened then, because when shares got below a certain level, it triggered more selling. That's what's happening here again.
Really briefly, the government talking about further details, fiscal plans in November. Can it wait that long economically, politically?
Well, the Bank of England just decided today it couldn't wait that long, but I think there will have to be political announcements too, and there will be big pressure on Kwasi Kwarteng to row back on some of what he did last week.
All right, Andy Verity, thanks so much for taking us through all of that. Thank you.